Welcome to Bauhaus Week Ahead, Week 22. As we look toward the days ahead, global markets remain on edge, walking the fine line between trade diplomacy and economic turbulence. President Trump's unexpected move to delay 50% reciprocal tariffs on European imports from June 1st to July 9th sparked immediate reactions. Equity futures surged, the dollar softened, and the euro momentarily touched 1.15 before retreating as market players debated whether this was a true thaw or merely a calm before another storm. Over in Asia, Premier Li Qiang signaled a counter-cyclical push through fiscal support measures, tax cuts, infrastructure boosts, and targeted credit lines, but factory activity and modest 3% profit growth reminded us that stimulus doesn't bloom overnight. In the realm of monetary policy, central banks continued their careful choreography. The European Central Bank delivered mixed signals. While Villeroy reminded us that normalization is far from over, hawkish voices like Holtzman and Nagel cautioned against premature rate trims. Lagarde's reference to a potential global euro moment excited hopes of currency strength, but for exporters, it also introduced fresh burdens. Meanwhile, in the US, all eyes turn to the Federal Reserve's May 28th meeting minutes. As investors decode whether inflation from tariffs is a blip or a trend, officials like Kashkari and Barkin have stressed patience, with future pivots depending entirely on real-world price and wage movements. The week also brought a wave of macro data. April's durable goods orders dropped significantly, down 6.3%, excluding defense, and 4.3%, excluding transportation, highlighting the most dramatic freeze in corporate investment since late 2024. Final revisions to Q1 GDP, due May 29th, will offer deeper clarity, while jobless claims data will reveal whether cracks are forming in the once-tight labor market. On May 30th, Core PCE, stripped of volatile food and energy, will serve as the Fed's truest gauge of inflation. A reading above 0.3% month-over-month or 2.6% year-over-year could stoke expectations for rate hikes, while anything softer may reignite discussions of easing. In commodities and energy, OPEC Plus ministers, now meeting on May 31st, appear poised to raise July production quotas by 400,000 barrels per day. While oil markets reacted with some price trimming, geopolitical risks, from Canadian wildfires to tensions in Eastern Europe, could easily reverse this. At the same time, alternative assets made headlines. Trump media's announcement of a $2.5 billion Bitcoin treasury investment pushed BTC above $70,000, emphasizing crypto's growing reputation as a store of value. Gold, meanwhile, held strong near $2,350 per ounce, supported by a weaker dollar and ongoing concerns over the US debt ceiling. On the tech frontier, all eyes are on Nvidia's May 29th earnings. Investors are anxious to see whether China-related GPU export restrictions will dent momentum, or whether demand from data centers and partnerships with Microsoft and Google will keep revenues charging ahead. The results could influence not just Nvidia, but competitors like AMD and Intel as well. In the EV space, Chinese giants BYD and Xiaomi slashed prices by 10 to 15%, intensifying market competition. Tesla may be forced into tighter margins as it scales production on its $25,000 Model 2, setting up a fierce pricing war where global tariffs and local incentives play pivotal roles. Zooming in on division-level impacts. In property management, rising bond yields are making refinancing more expensive, and wildfire risks are driving up insurance premiums. Now is the time to lock in long-term rates and conduct thorough wildfire risk assessments. Construction and development teams are feeling the squeeze from tariff-driven price swings in steel and lumber. Mitigate this by including price adjustment clauses in contracts and diversifying your supplier base. For real estate sales, buyer confidence is returning even as mortgage rates hold steady. Promote rate lock programs and highlight HELOC options to give buyers a sense of control. In maintenance and repairs, ongoing supply chain disruptions are delaying parts availability. Pre-stock critical spares and evaluate backup vendors now to avoid costly downtime. Financial strategy teams should be mindful of heightened portfolio volatility driven by policy shifts. Now's the time to rebalance toward dividends, tips, and defensives like utilities and healthcare. Looking ahead to week 23, the calendar is packed with must-watch data. On Tuesday, May 27th at 5:30 a.m. Pacific Daylight Time, Durable goods orders will provide early insight into corporate investment appetite amid trade tensions. Then, on Wednesday, May 28th at 11 a.m., the FOMC minutes will offer a nuanced look into the Fed's internal debates. Watch for language signaling concern over either inflation spikes or softening growth. Thursday, May 29th, brings multiple releases at 5:30 a.m. The final Q1 GDP revision, jobless claims, and further labor market indicators. These reports will help paint a clearer picture of economic momentum, or lack thereof, heading into the summer. On Friday, May 30th at 5:30 a.m., personal income and spending data will show whether consumers are still powering the recovery, while the goods trade balance will reflect the real-time effects of tariffs. Finally, that same morning, the Core PCE report will likely shape the Fed's next move, with markets bracing for any surprises. To stay ahead in this volatile environment, consider a few actionable insights. Hedge your supply chain exposure. Lock FX rates now if you import materials, or consider shifting to domestic sources. Revisit your inventory strategy. Pre-order critical components to stay ahead of potential tariff renewals. For those with refinancing needs, organize rate lock clinics to help secure fixed rate stability. And most importantly, translate these macro signals into meaningful guidance for clients and teams. Context matters now more than ever. Week 22 reminded us that data drives the story, but how we interpret that data sets the tone for action. As we dive into week 23, keep a sharp eye on durable goods, Fed minutes, and the all-important Core PCE. What's your strategy? Drop your insights on the comments below. And as always, stay sharp, stay curious, and above all, stay Bauhaus. Like, follow, and subscribe to our social media channels for more market updates and insights.